Hey, hi, Fabian.
Hi, how's it going?
Pretty well today. How are you?
Good, good. Stressful weekend, a lot of work, getting ready
Yeah,
for
yeah,
finals.
yeah, yeah. We got the final week here, and and we had the final exam obviously last week, so that I didn't want to put that the same week as the final case study because that'd be
Right.
a little too much work for everybody. So I split that up. But either way, yeah, I can appreciate a busy time. Well, let's wait for a few of your classmates to join us. We can we can kind of go through these final exam questions very quickly. Um, what I'll probably do is because I didn't have any short answers, I'll probably ask you and your classmates to talk about the multiple choice questions, and then the true or
Right.
false I'll just kind of run through myself and just discuss what the correct answer was and all that. Yeah, let's see who we got here. Hey, Emiliano, how you doing?
I'm doing well. How are you?
Good to see you.
Likewise.
All right. Yeah, I got your message, so I appreciate what you're saying. So I'm looking forward to seeing some of the work, and let me know if there's anything that's unclear. Or, if you run up against a clock, I might be able to extend things a day or two for you.
Thank you very much. I
Oh,
appreciate
yeah,
that.
no problem. No problem. Okay, well, it's just so far it's just Fabian and Emiliano. Let's see if a few more of you guys can join here first before because otherwise you guys will be doing a lot of talking, and I want to kind of spread the wealth if I can. I was just telling Fabian Emiliano that I'll probably ask you guys to explain why you selected the different multiple choice questions. And then I'll just kind of go through the true and false answers, the last 25 questions, which were true and false on the final exam questions. Oh, good. Okay, now we got Nina's joined us, Dylan's joined us. Okay, we got a majority, so let's get the show on the road here. So yeah, to Dylan and Nina, I was just telling Fabian and Emiliano that I wanted to go through the final exam questions. I think it makes more sense, excuse me, since there's no real short answer questions that you guys had to do on this, but maybe you guys could talk about why you selected the choices you made on the multiple choice questions, and then I'll just kind of run through the true and false questions because they're obviously not as involved. But anyway, let's get started here. So basically, we got number one, which is asking for a definition of incremental cash flow. Fabian, you got this one correct. What of the
Yeah.
choices here?
So,
What made sense to you?
so I took C, just because that's the definition of incremental cash flow, I guess.
Yeah, I mean, yeah, I don't know if this is going to be such a great idea to explain the multiple choices. I mean, you summed it up. I mean, it's because answer option C is correct. I mean, it's incremental cash flow is the increase in cash that a new project generates over and above, current cash flow that the company's experiencing. Um, these other ones are kind of, just make believe answers, operating cash flow, less free cash flow. What does that mean? C is the correct one. B, free cash flow, less salvage value. I was kind of trying to come up with things that were reasonable possibilities, but at the end of the day, C is obviously the right answer there. Yeah, I think I'm just going to go through these. It doesn't really make sense to ask you why you selected the different answers. And to be honest, almost everybody got just about everything right here. I only saw just a couple of situations where people didn't get the right answer on at least four everything except maybe 4 or 5, which was the most that anybody missed, which is great. I mean, so since everybody did pretty well, um, I'm just going to kind of whip through these real quick and maybe we can make it a short meeting. Okay, so number two, because some costs will be incurred whether a project is accepted or rejected. Um, D is the answer. They are not part of the decision, right? To accept or reject a project, since some costs really are going to be, they've already been incurred. There's nothing that either accepting or rejecting the project is going to have any impact on the sunk costs because they're already said and done. They've already been incurred. So I think that's a fairly obvious answer. Moving on to number three, the principal advantage of the dividend growth model as a basis for calculating a firm's cost of capital as it relates to common stock is what? And of the different answers, A probably makes the most sense. in that the model is relatively simple to use, simple to understand. It may be a little too simple. And I think another question later on talks about some of the shortcomings of the dividend growth model, or also known as the Gordon growth model. But we'll get to those. Okay, we'll get to those shortcomings in a later question. Okay. Next, they're talking about the definition of opportunity costs, and that's basically a benefit that's foregone due to the company selecting a particular project, or anybody can incur an opportunity cost by just if something is mutually exclusive and you choose one path to go down, then you can't go down the other paths, right? So the opportunity cost really is the missed chance or the missed opportunity to take advantage of different possibilities that you did not select, or that have been foregone. So A is the correct answer there. Okay, $1,000 bond, which is the face value or the future value, got a 5% coupon rate, so that means that coupon payments are going to be $50 every period. And in this case, coupon payments are on a semi-annual basis, so that means that coupon payments are going to be $25 every 6 months, right? If the bondholder has a required rate of return of 6%, which turns into 3% on a semi-annual basis, what will be the value of this bond with 4 years left to maturity, which means 8 semi-annual periods, right? So I'm not going to do this right now with my calculator, but if you punch those semi-annual converted amounts into a calculator, you're going to end up getting a different number than all of these. You're not going to get, I guess I could do it, 1,055. I had done this before, just obviously to get an answer, and then I didn't include it in any of the options. But if we got $1,000 is a future value, okay? We got 1,000 equals future value. If we got 3 equals I divided by Y, 8 is going to be N. 25 equals payment. And if I compute the present value, I get 964.90. So I don't see 964.90 listed. Instead, I went through that exercise when I was creating this problem, that same calculator exercise, and I then chose 3 numbers that, or 4 other numbers which were fairly close, but not the exact amount. So E is the correct answer there. None of the above. Okay. Now moving on, we come to a rather basic question, and that is bond prices and interest rates. What's that relationship? Well, they have an inverse relationship, right? As interest rates rise, bond prices are going to fall. And if interest rates fall, then bond prices are going to rise. And that all has to do with the fact that interest rates are used as a discount rate when you're computing the present value of any future cash flows that come from a bond. Obviously, as interest rates rise, that means you're discounting future cash flows at a greater rate. And, your bond value, your bond price will be lower. And then obviously vice versa. So they have an inverse relationship, kind of like a teeter-totter, people often compare it to. Okay, a bond with a $1,000 face value again, but it's currently selling for 980 is what? Well, it's selling at a discount, right? It's not losing money. It's certainly not at a premium. it certainly should not be purchased in every single case you come across. A lot more depends on, the price. The price could be overvalued. If, let's say, you got an interest rate forecast and you expect interest rates to rise even more. You probably wouldn't want to even invest in bonds, but you might not want to buy, a $980 priced bond on a $1,000 face if you've got an interest rate forecast that's calling for interest rates to rise. So you can't say D. So yeah, it's selling at a discount basically, and that's really the definition of what a discount is a bond that is selling for less in the marketplace than its face. Okay, moving on. Number 8, we've got bonds. I just explained this. Bonds are often valued using what? Well, present value techniques, right? We we look at the future cash flow from a bond, and we present value at our required rate of return, or a prevailing interest rate that we think is fair and makes sense based on the economy. But it's certainly not random walk or economic value techniques, or certainly not salvage value, which has nothing to do with bonds, or face value techniques. I just made up that answer. So it's E, definitely present value techniques. Okay, moving on. 9, working capital requirements associated with the project may increase upfront costs, right, of a project, but also lead to cost reductions at the end of the project, as that working capital may end up being recaptured at the end of the project. For some of you that are in my other course, where we've actually gone through some case studies on cash flow on projects, there have been instances where there was a working capital requirement, and that involved a cost that was upfront, a required expenditure in working capital to get the project started. But then, the parameters of the case indicated that working capital was recaptured at the end of the project. So that's why B here is the correct answer. That working capital requirements may increase in upfront cost of a project, but also potentially lead to cost reductions at the end of the project. Okay. Number 10, shortcomings of the payback method. I think just about everybody got all of these correct, but there are 2 that are listed here. And one of the shortcomings is A, that it does not account for the time value of money, which we know. But another shortcoming, which it isn't always real clear, or it isn't always highlighted as A is that B is another shortcoming, that the payback, once you calculate a payback, you get a number, right? You get like a 2-year period, a 2.5-year period, whatever it is that you come up with as a payback. But any cash flow that happens, any cash inflow, or if there's additional cash outflows that occur after the break-even point is calculated, they're not considered. They're not part of the calculation. So that's, that could be a potential problem in evaluating any kind of a project just based simply on a payback method. It's always best to use payback in conjunction with net present value and internal rate of return, and even potentially some other methodologies. Okay, so here we are still on time value of money and capital evaluation. Net present value NPV rule may be summarized as what? Well, it's basically that any projects with positive net present values are acceptable. Now, maybe I should have clarified this in that, you're not going to always accept every single project that has a positive NPV, because some may be mutually exclusive. Like if you choose project A, then maybe you can't choose project B, and vice versa. So then you would choose the project that has the highest net present value, right? Makes sense. But anyway, the general rule uh, of the NPV rule is that anything that's going to generate a positive net present value is acceptable. All right, what do we got here? Okay, a particular period in the analysis of project is giving you the data that EBIT is 250, tax is 75, depreciation expense is 50, and working capital spending requirement is 80. So as a result, free cash flow for the period, well, it's going to be the EBIT, right? Less tax, um, less interest, less depreciation rather, because remember that EBIT is earnings before interest and tax. Okay, so if you have EBIT on a line on your income statement, then depreciation expense and tax are going to fall beyond or below that, right? And you're also going to have this additional 80. So if you take the 250 and you subtract out the 75 and the 50 and the 80, you should get 145. Anyway, everybody, I think, got that one. Let me just take a quick look and make sure that I'm correct in that statement. I don't see anybody missing 12.
Don't you add the depreciation expense instead of subtract it?
Yeah, Emiliano, I'm sorry. Go ahead.
Don't you add the depreciation expense instead of subtract it?
Correct. I made a mistake. I was just going right down the line saying subtract everything. No, very good. Very good catch. Yeah, that's exactly right. So let me just do it then. I want to make sure that I got a correct answer here. So if we got even at 250, right? And we take away 75, and we take away 50, right? But then we add the 80 back. Why am I having a problem with this? I don't get 145. Let me try it again. 250, right? Minus 75 minus 50 equals 125. Add back. Oh, and I'm doing it wrong. 250, right? Minus 75 for the depreciation. I'm sorry, for the tax, plus 80 plus 50. Darn it. Darn it again. Boy, it's a good thing I didn't take my own final. I probably would have failed it. 250 minus 75 plus 50. No, minus 50, right? Wait. Depreciation is 50 plus 50. Geez, minus 80 is 145. Hey, so yeah, that is the formula for that. And thank you again, Emiliano, for pointing out that yeah, depreciation is an add back when you're converting an income statement presentation into cash flow. Depreciation is a non-expense, non-cash expense, so that is added back. Okay, company has a beta 0.7. Expected return on the market is 10%, and the current risk-free rate is 3%. What is the cost of capital? Um, I don't have the formula in front of me for capital asset pricing model, but trust me that is D, 7.9%. Anybody has any questions on that or didn't understand it, let me know and I'll lay it out for you. But since I don't have it in front of me, and I can't remember it, I don't have these formulas memorized. Um, I can't show you exactly how the 7.9 is calculated. I should have put that on this answer sheet since this is the one that has all the answers, but I didn't. Okay, moving on. 14, a company has decided to issue additional common stock in order to raise funds. Current price of stock is 15. This is going to be another capital asset pricing model. The answer is 8.11% or C. I did calculate it correctly. I know because I did all these before I put them on the final. But unfortunately, I didn't save my notes on it, so I can't. I'll do the same thing. If anybody has any questions on these, if you missed them or had a problem, it looks like just about everybody got this one right. I see one exception to that. So if you've got any question, I won't call you out on it. But if you got any questions on any of these, please, um, shoot me an email when we're done, or anytime, before the end of the course, and I'll go back and lay out any calculations. But yeah, most of these I just want to talk about, as they involve conceptual ideas, not so much the calculations, which I don't have in front of me, unfortunately. But anyway, let's move forward. Because companies typically use sales forecasts for scheduling production. A couple of you got this one wrong, which, I can understand. You could potentially put down, errors are likely to be made due to uncertainty. I mean, that's always a possibility in any kind of a forecasting process. But really, expenditures or disbursements are also closely tied into any revenue forecast or any sales forecast. So the correct answer is B. Okay. But yeah, answers like D, sales forecast must be error free. No, not necessarily. I mean, obviously your forecasts, you want them to be as accurate as possible, but they're never going to be error free. Anytime you forecast anything, it's always subject to some error. That that the whole idea is to try to get a forecast that's reasonably accurate and logically put together with assumptions that are documented, so that you can compare those assumptions to reality down the road if you have any major differences between operating results and what you are forecasting. Okay, moving on. 16, we got short-term credit sources can be classified into two basic groups, and those are unsecured and secured sources of short-term credit. Let's see. Moving on. 17. The percentage of sales method of financial forecasting provides reasonable estimates of a firm's financing requirements. And if you look at the answers, I mean, B is fairly obvious. I mean, it's that method of forecasting is only going to make any sense when asset requirements can be, accurately forecasted as a constant percent of sales, right? Otherwise, using a percentage of sales method is not going to give you very good forecasting results. So if your business is such that asset requirements can be accurately forecasted as a constant percent of sales, then yeah, a percentage of sales method will make sense. But that's rare indeed when a company's asset requirements are a fixed or a constant percent of sales. All sorts of requirements are going to cause that to vary. So percentage of sales is an easy method to use when you're forecasting, but it's not necessarily the best method for that very reason. Okay. So anyway, let's move on. 18, an investor in a world of perfect markets, okay, would argue that a firm's value is determined strictly by what? Well, investment and financing decisions, and that is dividend policy has no real impact, and that has to do um, with random walk, with efficient markets, and just about every generally logical means whereby you are talking about the value of a firm um, in the future, in the short term, and in the long term. So yeah, so A is the answer there. Let's keep moving here. 19. Okay, a manufacturing firm has fixed operating costs. 5 million. Variable costs are equal to 55% of revenue. Its break-even point will be approximately. Here's another calculation problem. So let me know if you have any questions, but it should be 11.1 million. I think just about everybody got that one right. Let's just take a quick look. Everybody did. Every one of you got that right. So you guys were right on the stick when it comes to break even, which is great. Okay, 20. To determine differential annual free cash flows, it is necessary to first determine what? Well, the annual change in operating cash flow is obviously the correct answer there, because you're talking about differential annual cash flow, right? So that's essentially related directly to annual change in operating cash flow. So A is the correct answer there. 21, a regular cash dividend is a dividend that a company pays out routinely, okay, to shareholders, often quarterly, often the same from quarter to quarter. You know, if they have a fixed dividend policy, sometimes dividends may fluctuate based on operating results of a company, or if the board of directors, um, thinks it makes sense to, either increase or decrease dividends based on operating results. But, typically, the answer is the regular cash dividend routinely to shareholders, um, quarterly, and usually the same amount. Okay, 22. Which of the following 1,000 face value securities has the highest yield? So this, you have to go back and do a present value calculation, and you got to solve for rate. Okay, so if you've got a $1,000 face, that means you get the future value is 1,000. Picking just A, if you got a 5% coupon value, that means it doesn't say anything about semi-annual payments or anything. So you can use an annual payment, coupon payment, and 5% of 1,000 is going to be 50. So you would have an annual payment of 50. It doesn't talk about any period of time until maturity. So you can pick one, pick a time, a maturity time, but you would have to use that same time for all 5 options, right? You can't say, oh, for A it's going to be 5 years, for B it's going to be 10 years, because that's not really comparing apples to apples, right? You got to make everything the same as far as maturity goes, but just end up calculating for rate based on your future value, which is a face, your coupon payment, which you can calculate based on the percentage coupon information that's provided. You know what the bond's selling for, so that's your present value, which you enter into Excel or into a calculator as a negative value, and then you solve for I divided by Y, or you set up your Excel spreadsheet to calculate for rate. So if you do that for A, B, C, D, and E, you're going to get the lowest rate for C. Okay. Um, and once again, if you have questions on that, please let me know. I'll whip through the calculation and post it or send it to everybody that's got any questions on that. But just let me know. But yeah, 22. The answer is C, the 12% coupon bond that's selling for $1,000. Okay, 23, which of the following $1,000 face value securities has the lowest yield? So obviously we're going through the same process. Got to do a rate calculation again, and in this case, the 7% coupon bond selling for 1,100, or option B is going to give you the lowest yield or the lowest rate. Okay. Looks like I was getting into a calculation mode here. 24 is another calculation. A regular annuity of $500 per year for 25 years at a required rate of return of 5% will have a present value of how much? So you just got to do a present value calculation. Um, um, $500, which is paid every year for 25 years. So 500 is your payment, 25 is N, 5% is your I divided by Y, punching in the present value, or computing for the present value, I should say, is going to give you answer C, which is 7,046.97. Okay. Another one. Here we go. A perpetuity. Okay, so you got 750 as your amount. And in order to figure that out, you've got to take 750 and divide it by the interest rate, right? So let me just make sure that's correct. 750 divided by 0.04 equals 18,750, which is A. Correct. So I did that one correctly. But yeah, that you remember that the perpetuity formula is always going to be your amount that's being paid forever, more or less, divided by the required rate of return is going to give you the present value or the current value of that ongoing stream of cash inflows or perpetuity. Okay. 26, an important benefit of a payback period calculation is that it deals with cash flows as opposed to accounting profits. Well, just about any capital valuation technique is going to deal with cash flow and not accounting profit, but payback is a method of capital evaluation, so it is indeed cash flows that it deals with, and it is true that is an important part of the calculation, an important benefit of it. So 26 is true. 27, the discounted payback period is defined as the number of years it takes to recapture a project's initial outlay from the future value of free cash flows. Well, no, because you have to, you can't say the future value of the free cash flows. It's going to be the present value of future cash flows, right? That's what has to be applied to the initial cost. So it's going to be, to recapture a project's initial outlay from the present value of future cash flows. So I probably took that right out of the text, but I reworded it a little bit to make it a false statement. Everybody good with that? Okay, 28, moving on. Changes in net working capital generally include both increases in inventory and increases in accounts receivable that naturally occur as sales increases from the introduction of a new product line. Yeah, I mean, if you remember what the definition of net working capital is, it's changes in current assets minus current liabilities, right? That's the definition of net working capital. So increases in inventory or accounts receivable are going to affect net working capital. So you can deduce that that statement is correct based on that, the wording of those potential inputs that are changing. Okay. So yeah, so 28 is going to be a true statement. Um, Moving to 29, some companies choose to raise dividends every fourth quarter by the same percentage amount. Um, just offhand, I can only assume I got this right out of the text, but it's a true statement. I'm just looking through my little cheat sheet here. And it looks like every one of you got this one right. So it doesn't sound like there's any more explanation is really needed here. But it is a statement right out of the text. And I guess it makes some sense that, some companies choose to, increase their final dividend of the year, the fourth quarter dividend, by the same percentage amount um, every time it occurs every fourth quarter. Yeah, I guess some companies just like to give everybody a little bit of a bonus when it comes to increasing the final quarter's dividend of the year. Moving on, 30, taxes historically have been higher on ordinary income than on capital gain. And because investors do not pay taxes on capital gains until they realize them, they can postpone taxes until they sell the shares. And that's another statement that's right out of one of the texts. I can't remember which one it is, but yeah, that's right out of the book. Um, Looking through my cheat sheet, looks like everybody got that one right, so I don't see any reason to spend any more time talking about that one. Moving on, 31. Often a loan for a startup venture takes place only when the borrower has sufficient income or sufficient assets outside the new business that the borrower can pledge, as collateral for the loan, which, I'd like to think that makes, common sense that that's a true statement. Um, Particularly if it's a sole proprietorship. Um, but in any case, the owner of a new business or even a group of owners, if it's like a partnership or even a company, um, is not necessarily going to follow through on borrowing. Okay, if they don't have sufficient collateral that they can put up um, against that loan, right? Makes sense. So basically, 31 is true. 32, corporations commonly purchase fixed assets, revise their financial structure. No, um, corporations will commonly issue bonds or go through an IPO, an initial public offering of common stock, or issue additional common stock to revise their financial structure. They're not going to purchase fixed assets, not to revise their financial structure anyway. They're going to purchase fixed assets maybe to revise their operating structure of their business or to increase their degree of operating leverage, but not to revise their financial structure. Okay, so moving on to 33, companies will rarely use retained earnings as an equity source due to its relatively high costs um, as compared to issuing stock or bonds. No, retained earnings once you have um, generated earnings and they're sitting on your balance sheet in the form of owner's equity or shareholders' equity of some form, then they're relatively inexpensive as compared to issuing bonds or going through IPO process to issue stock to raise money. Essentially, retained earnings is almost always going to be a less expensive means of financing a company than those other alternatives. So that's a false statement. 34, due to agency costs, the stock price of a company owned by investors who are separate from the management may be less than the stock price of a closely held firm. Well, if you stop and think about that, that's an interesting statement. It's a true statement. And the reason is that if you've got stock price of a closely held firm without a big disparity between ownership and shareholders, if there's not a big disparity, then there's going to be less likely a less likely possibility of agency costs or significant agency costs. And as I'm sure you all know, the agency agency costs arise from disparities between ownership and in the form of shareholders and your active management of the company. Okay, so if there's little agency cost, because you have a closely held firm situation, then you're probably not going to have a big disparity in stock price. Okay, makes sense. Looking through here on the cheat sheet, everybody got that right. So I probably didn't have to go into all that. Okay, 35. The WACC is a critical value in finance that we all know. It is often used as the appropriate discount rate for a project in the NPV capital budget decision model. And it's a hurdle rate in the IRR capital budget decision. I think I've already talked about that, but that's definitely a true statement. When you go through the process of calculating your WACC, or a company goes through their process of calculating their WACC, you have a good idea of how much it's costing. You know, in the form of a percentage rate when you're financing your company. So that's obviously not a good discount rate to use, a good cost of money figure to use, a good hurdle rate, which I mean by that, I mean if the internal rate of return you calculate for a project exceeds that rate's like the hurdle, right? So if you come up with an IRR that's greater than that hurdle rate or that WACC percentage, then you know it's likely to be a good project to proceed on. So yeah, so that's a true statement. 36, a bond purchase costs are called its cash flows. No, nope. Couple people did get this one wrong. I was a bit surprised. A bond purchase costs are not as cash flows. It's inflows. It's cash inflows. It's coupon payments, and it's final maturity value that's paid out at the end of the contract. Bond contract term is are its cash flows. Okay, makes sense. Those are the inflows. Any outflows associated with the bond are what you paid originally to purchase the bond as an investor. So yeah, definitely a false statement there. 37, if corporations suffer significant losses, the demand for its bonds will rise due to the higher interest rates the firm must pay. No, not at all. If a company is suffering significant losses, the possibility of a bond default might occur, that the company might not be able to make its coupon payments, or it might not be able to make its final maturity face value payment to its bondholders, and as a result of that, there would likely be a lower demand for any bonds. The demand by investors, potential investors, would certainly not increase uh, if a company was, suffering losses. So, yeah, definitely a false statement there. The most complex application for assigning beta to a project is pure play. Um, Definitely a false statement. I'm not sure exactly where I got it. I probably got um, there's probably a statement in one of the texts that talks about what the most complex application for assigning beta is. Offhand, I don't know what that would be other than just understanding total risk and having a good feeling for future cash flows from any project or investment for which you're looking to assign a beta. Okay, that's probably the most complex problem or application for involved in selecting a beta. But pure play, no, pure play is just has to do with random walk and just generalities and changes within the economy for any given project or any given investment. So beta would have little to do with any concept of a pure play. So definitely a false statement there. Um, Bond investments are often referred to as debt securities. Yes, it's that's one of the definitions of what debt securities or what bonds are, is that they're fixed um, securities, also known as debt securities, and they are things to be um, actually avoided if you have a forecast of interest rates um, rising significantly. You want to stay away from debt, and you want to stay away from fixed income securities. Okay, 40. To deal with criticism that the payback period ignores the time value of money, some firms use a discounted payback period approach. Um, yeah, that's all common sense, right? When the discounted payback period is essentially using payback, but it's using the discounted cash flows of the future cash inflows of the project, as opposed to just the straight undiscounted dollar amounts that are provided. So you have to, choose a discount rate, apply that discount rate to the future cash flows, compare that to the initial cost, and see if the project pays back, and if it does pay back, how long it takes um, to recapture that initial cost. So yeah, so 40 is definitely a true statement. 41, we're moving to IRR now. A project's IRR measures the net value of the investment proposal in terms of today's dollars. No, it doesn't have to do with um, investment in terms of dollars. It's going to give you a percentage, right? And the internal rate of return then, if you've got a WACC rate, which you're using as your hurdle rate, then you know what your IRR threshold percentage is going to be. If your IRR percentage exceeds that WACC rate or the hurdle rate, the threshold rate, however you want to describe that, then you would accept a project or an investment. But if the IRR is less, then you would do well to avoid that project. So yeah, that's definitely a false statement. It's really percentages we're talking about, not today's dollar values. Okay, 42. The fact that the time value of money solution often yield negative values when calculated by calculators or spreadsheets is due to a concept often referred to as the input convention. Well, I'm sorry to say if you got this wrong, I'm not sure where this is discussed specifically in the text. And if it's not, I might go back and give everybody credit on it. But it's really something called the sign convention. And if you do a little internet search on sign convention or time value of money sign convention or financial calculator sign convention, you'll get a discussion of why you've got to input a negative value if you are expecting a positive result, and if you enter um, positive values into a calculator or into Excel, you're going to get a negative value for the present value when all is said and done from either Excel or the financial calculator. And that has to do with the sign convention. And the sign convention really has to do with cash inflows and outflows. So if you're calculating the present value of $1,000 5 years in the future at 5%, and you enter in all that information, you're going to get a negative value in Excel or in your financial calculator when you compute the present value. And the reason for that is that you're assuming that the cash inflow is going to happen in the future, the 5 years out from now, which by then definition means that you're putting the present value into interest bearing account, or something that's going to give you you know uh, a greater value at some point in the future. So that would be an outflow, right? So that would be the reason it would be a negative value. The assumption is then that the future value is going to be a cash in, while your the initial present value would be you know taking that money out of your pocket and putting it into a bank account or an investment. So that would be a cash outflow, at least for you personally. So that has to do with the entire idea of what is called the sign convention. Okay, 43. Company can handle cash shortfalls in 4 ways. This is right out of the text. Cash from savings, yeah, unsecured loans, letters of credit, secured loans, other sources such as commercial paper and trade credit and bankers acceptances and things like that. But yeah, that's basically how different companies can handle cash shortfall. Um, and that's, like I said, right out of the text. Okay, 44. Debt financing may increase the risk of default. Well, yeah, I mean, if you have a company that's financing through debt, that means they're potentially issuing bonds, right? And the more bonds a company issues, or the more series of bonds that a company issues, the greater there is a potential risk, anyway, of default. Um, it doesn't mean that a company that does a lot of debt financing is going to default, but it may, and that's the key answer there, is that debt financing may increase the risk of default. So that's a true statement. Um, okay, 45. A company requires an 8% minimum rate of return. It's going to pay a dividend of $3 per share next year, um, which is expected then to increase by 6% annually. So the intrinsic value of the stock is going to be 150. And that's using the Gordon growth model. I don't have that right in front of me, but like any of the other calculation problems here on this exam, if you got any questions, just shoot me a message and I'll be happy to lay it out for you. Um, okay, getting near the end here. 46. Angel investors are lenders who provide funding for new but low risk ideas. No, it's quite the reverse. Angel investors are known to potentially get involved in relatively high risk ideas. But what the angel is hoping for, obviously, is the success and a significant return on their investment by investing in a potential risky undertaking with the company that they choose to help finance. So yeah, so that's a false statement. The low risk idea is what makes that a false statement. That portion of the statement. Okay, 47. The initial phase of corporate borrowing is usually connected directly with commercial banks through lines of credit, bank loans, and syndicated loans. Yeah, that's a tough question. I know a few of you missed it, but the initial phase. I mean, you got to think about what the statement is really saying here. The initial phase of corporate borrowing. The most common, and I guess I could have said maybe common. I could have worded this a little bit differently, but I think this does come right out of one of the textbooks. The initial phase of corporate borrowing, uh, and usually is a key word that's in here too. It's usually connected with banking, um, lines of credit, bank loans, syndicated loans, um, different financial institutions that make their bread and butter by actually making loans to individuals and businesses. In this case, so that's you're gonna say that's got to be a false statement. The initial phase is really based on other ideas that are not necessarily directly connected with those financial institutions. Okay. 48. Because of both the risk of failure and agency costs, uh, they accompany the excessive use of leverage. The financial manager must exercise caution in the use of fixed charge capital. Um, yeah, you got to say that the way the statement is kind of worded, because the risk of failure and agency costs accompany excessive use of leverage, then anytime you're talking about fixed charge capital, you got to be careful with what you're doing, right? Makes sense. So that's a true statement. 49 then, with an interest rate of 10%. Okay, the present value of a security that pays $1,100 next year and $1,460. 4 years from now is approximately 2,000. If you go through the present value calculations of that, then you're going to come up with that is approximately 2,000. I think it's like 1999 and some change or something like that. But I remember going through that calculation too. But once again, if you got any questions on that, just let me know. And the last question here. Okay. With an interest rate of 6%, the present value of 100 received 1 year from now is approximately 106. Well, no, it's the present value of any money that's received in the future is going to be less, right? Than that face value of the present value 100 received a year out from now is going to be what, $94, right? Not 106. It's going to be 6% less, or $6 less out of that $100. So yeah, so 94 would be the answer. 106 is false. So that should do it. I mean, good job, everybody. I mean, I'm looking through the grades. I see a lot of -2, -4, -4. A lot of very good, performances here. A couple of you missed more than that, but I don't think it's in any way going to hurt your grade terribly. Even if you get in 70 percentage range, because, you know, I did design this in such a way that I didn't want the final exam to be any more than, 20% of the total grade. And that's exactly what it's gonna come to. It's, 20 points, I believe, out of the 50 questions. It's valued at 20 points, and, I'm basing everything on, a 100-point total for the course. So everybody did pretty well. And if you didn't do great, you still did well enough that it's not gonna ruin your grade, for based on everything else you've done. So good job, everybody. I'm pretty pleased with what I see. And I don't really have any more for anyone today on this. We'll talk about what's going on with everybody next week. We've got the Great Plains serial case coming up next week, and I hope you all enjoy the case and the teamwork elements of it. There's only 5 of you, so one team has 2 people, and one has 3. So, if you need any inputs, or, if you'd like me to answer any questions, please don't hesitate to contact me during the week. But I'm looking forward to seeing that final case. And until then, I guess we'll wrap it up here, and we'll have one more meeting on Friday. I don't think we have any schedule for beyond this, because we are in fact in the week 10. So we'll have another meeting on Wednesday, but I won't have much to go over unless you have questions on the case study that you're actually working on. Okay. So I think that's pretty much it, everybody. Thanks a lot. Anybody have any questions before we go? Everybody good? Sounds like it. Okay. All right, everybody. We'll see
Thank
you
you.
soon.
Yeah.
Thanks so much. Bye-bye,
All right,
everybody.
see you later.
Thank you.
Okay. Thanks, everyone. Bye-bye.